Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 293 today, 18th of October. And today we're going to talk about top 10 personal finance rules. A recent tweet that I had got a forward from somewhere and I had uploaded on Twitter, and that got a lot of response. A lot of people showed interest in that tweet, so we thought it's best to share it widely through this channel as well. So we'll go through some of those rules in part 1 of the video today. But first, a look at the market. Market opened with a bang, and the gap up continued from yesterday. The US markets also were extremely strong. There are indications that this may be the last hike for now from the Fed coming through November. And that maybe there are other central banks who are coming around to the view that not much more hikes may be possible to do. And even at RBI, there have been notes of dissent about allowing interest rates to go much further, at least for now. And because there is a lag effect after the interest rate hike, and inflation can take 1, 2 or 3, even 3 quarters for that impact to come through. So many members of the RBI committee are of the view that we should not hurry into trying to raise the rates and curbing inflation immediately. So but PSU banks were on fire, plus 4% again. So this week PSU banks are up almost 8%. Real estate stocks, which were battered yesterday, came back very strongly, 1.72%. Consumption stories up 1.5%. And all other stocks, all other sectors also rallied through. So a reasonably good week that is developing. In the last 1 week, no sector except metals are in the green, and the recent losses seem to have been reduced, if not eliminated totally. All the indices were in the range of 0.8 to 1.1%. With Nifty next 50 doing the best at 1.03%, and weekend investing strategies doing extremely well, 2.27% up on NNF10, ATH2 up 2%, all cap up 1.8%, MI20, EverGreen, mostly strategies were up 1.5 to 2%. MI50 was the biggest laggard at 0.86%. Heatmap for the day. Only HDFC seems to be red here, along with NTPC and nothing else actually. Reliance, very strong mover, plus 1.76%. ITC 2.5%. Nestle, Bharti, Adani Enterprise, Adani Ports, L&T all up nearly about 2%. Mahindra, SBI Life, IndusInd Bank, State Bank smartly up 3.5%. SBI I've seen is that one stock which, when leads upwards, is a very good indication that the market is in for a good run. The probability is very high actually, and so is on the downside. So SBI for me is a very major lead indicator for the market. Of course, it doesn't happen always, but it's a good probability that the market will now have a nice leg up. Karur Vysya up 8.5%, BHEL up 8.5%, RHI up at 7%, NHPC, Gujarat Alkali also up 6 to 6.5%. So very nice gains on some of these stocks. The losers, Motherson down 7.5%, Tata Elxsi day 2 down 7.5%. So almost 7 to 8% down yesterday and 7.5% down yesterday. So Tata Elxsi really killed the short-term bulls here. Naveen Fluorine minus 3%, Max Healthcare and Schaeffler also down about 3%. You can see the Tata Elxsi episode yesterday that we did, and it showed how we have remained very patiently attached to Tata Elxsi as a 5-bagger, and then we just were lucky to get out in the nick of the time last week. So rules of finance, personal rules of finance that a lot of people like, and this is part 1 of this series. The first rule is rule of 72. A lot of you may already know all these rules, but nevertheless, for newcomers and for people who don't know about it, Rule of 72 is a fantastic rule where if you want to know the number of years required to double your money, at a specific, let's say, given rate, CAGR, then you just divide 72 by that return rate. So let's say you say, I'm expecting a return of 6% on my portfolio. So how many years will it take for my portfolio to double? So 72 divided by 6, so you get the number 12. So 12 years it will take for you to double your money if you are, portfolio returns 6% to you. Let's say now portfolio is returning 12%, like most mutual funds over a longer period do. Then 72 by 12 is 6 years. So in every 6 years, you are doubling your money if your CAGR is 12%. And the point that I want to actually highlight here is that if you just increase that 12 to 15, if your rate of return CAGR can go from 12 to 15 by by some strategy or by your own intervention or by following a good small case, if you can reach 15, then you're doubling every 4.8 or 8%, which is extremely good. I mean, if you can do it with scale, 4.8 years doubling is extremely very good. And of course, if you are a great investor, trader, and you're, let's say, doing 25% type of returns every year, then you're doubling your money every 2.9 years, and you will be having your house next to Antilia very, very soon. So from that perspective, the rule of 72 is extremely good. Then there is a rule of 70. What is this rule of 70? Rule of 70 is divide 70 by current inflation rate to know how fast the value of your money is going to get reduced to half its present value. So it's somewhat a opposite or the inverse of the previous one, where you're saying, let's say our inflation right now is 7%. So in 10 years, my money will get reduced to half. If the inflation remains 7%, then my money will get reduced from its current present value by half in about 10 years. USA is about 8.2% inflation right now. So if this inflation persists, which of course it should not, because at 8.2% USA will be a mess within a year. But if it does, then the time taken for money to reduce to half is 9 years, so on and so forth. So for most part in the last decade we were between 4 and 5%. So it would have taken a very long period for our money to go to half, even if we did nothing with it and we kept it under the mattress. Third is the 4% rule. What is the 4% rule? 4% rule is loved by retirees or people who wish to get away from regular income, getting away from jobs and having to run on a daily basis to make money. So the idea is to get to a corpus, and once that corpus is invested into some portfolio, and if you can withdraw 4% every year, and that 4% be equal to your current annual expense, then you are all right. I mean, as long as your corpus is meeting or beating inflation, and that 4% is good enough for your living expenses for the year, then you are okay with 4%. So the studies have shown that this rule has worked 96% of the time in any given 30-year period over the last 100 years. But to be on a safer side, because the interest rate regimes can really change over decades. So if you go to 50 times your annual expense, that will be a more comfortable metric. So if your annual expenditure is say 5 lakhs, then 50 times 5 lakhs is 2.5 crores. 2.5 crores of portfolio invested in a diversified asset allocated way, and I'm not suggesting this 50% fixed income and 50% equity. This is from the example, but one could diversify into equity and real estate and gold and some fixed income, and then draw 4% from there. I think you will be okay doing that. But of course, annual expenditure also can go up, and that is a domain of the personal finance that you need to delve into regarding the goals and your desires in life going forward. 100 minus age rule is another one where you say that, if my age is, let's say 50, so 100 minus 50 is 50, so equity goes to 50 and debt goes to the rest of it. So if the age is 30, 100 minus 30 is 70, so 70% allocate to equity, 30% to debt. If age is 60, 40% to equity, debt goes 60%. I don't agree with this debt of this high. I think one should get real assets instead of debt. So debt maybe 10%, and one can go for some real estate and gold in place of that particular component. But I agree with the equity part. If you are 30 years of age, 70% equity is quite good. So 100 minus age rule is something that is very good. Then there's another rule, 10-5-3 expectation rule, which kind of says you should have reasonable expectations from returns. This is actually more in context with US markets. So there they have sort of made a thumb rule that if you're getting 10% returns from equity or mutual funds, that's a good expectation to get from equity. 5% from debt, fixed deposits or other debt instruments, 3% from savings account. Actually now it works in India also, similar sort of rates. But again, this mix is not the entire mix that one should have, but maybe it can be 15, 10, 5 or 6 kind of an expectation rule, where 15 is your expected from equities, 10 is expected from maybe like gold, and 6 to 8 may be expected from real estate. So and of course your savings and fixed deposits can come after that. So this was just a small refresher on these personal rules. This was part 1 of the series. We'll do part 2 another time. So thank you so much for your time, and please do share this video with your friends and family, and I'll see you in another one. Bye.